Welcome to Nicker's Bullpen. Question a lot of people is asking is, are we in a market crash? Well, let's get right to it. I'm going to show you right off the bat. The answer is no. There you go. No, we are not in a market crash. There's nothing like a market crash. I can show you a market crash. This ain't a market crash. Matter of fact, let's go take a peek real quick. I'm going to show you what a market crash actually looks like. All right, let's pull all the way back. There we go. All right, this over here, right? That's a market crash. Okay, everybody's aware of the 2008 crash. That is a market crash. Okay, we are not in a market crash. Let me back it back up. Since 2008, we've been in a continuation uptrend. Okay, this has not fell back once. It only fell back once here, actually, to roughly about 226, 30, 27. All right, that's the first time it actually pulled back. And this is the COVID drop when they announced COVID and everything's going crazy. This thing fell down, right? This is a technical crash, okay? Because it crashed, and then it immediately bounced back because the Feds got on the news and says, "Hey, we're going to put in 2.5 trillion dollars to save the market." And of course, look at that. They saved the market, and it caused this overextended bull move. That's the Feds did a pump, and now the dump. So anyway, we got the pump. So that which got us to 479.98. So again, are we in a crash? So let's go and get right here. A lot of you guys need to understand you got to learn how to use Fibonacci's. Okay, Fibonacci's. Now, what tells you that a trend is crashing versus a healthy pullback? Well, let's pull up the Fibonacci, and there you go. That's how you can tell the difference between a crash and a healthy pullback. The healthy pullback is that from the low of around 218.8 to 479.98, the 50% retracement is 349.14. We landed at 348.11. So no, this is not a crash. This was a healthy pullback. After being bullish, right, for so many years, okay, it's back up again. 2008, the top of 2008 is right here. Okay, so we're not technically in a bull market from after 2008 when we got into 2009. We're not technically in a bull market until we finally reached into 2013. Why? It's because if we would have rejected there, then it would have became a double top, and we still would have been back going down again, which did happen. 2000, then we double topped to 2008, and then now we're pulling back up again. This would be the third top, right? The triple top, but we did get the breakout. Once we got that breakout, that's when we hit the bull market, okay? You got a bull trend. 2013, roughly around about March 4th, that turned into the bull market, all right? So as you see here, it comes up, resets a little bit, touching the 200 SMA, keeps going. We got over a little overextended here, right? This little move right here. This is the 2009. This is the 2018 pullback. This is not a crash. All it is come back to retap the 200 SMA. Take a look again from 2000 from when we broke out around 2013, right? Actually, let me rephrase that. Around 2011, you see how we touched the 200 SMA. We go up. We just got too far away from it. We had to come back. Tap the 200 SMA. Tap the 200 SMA. We come back up. Here's the 2018 crash. Okay, as they called it. It turns out it's not a crash. It just pulled back. Easy, people. It's just pulled back. So we got that move up again. Sure enough, bam. We dropped down. Now, I call this as a crash because of the fact that it fell so hard, so quickly. But this V-shaped retracement was exactly that. It recovered quickly. Same thing here, right? In 2018, right before we got right before we was getting back into 19, it just it V-shaped up here, comes down V-shape. All right. So these are this is an actual crash, but not here. But maybe you call it a breakdown. Still, not really calling it much of a crash. But anyway, it's argumentative at best. But right now, the question is whether or not are we finally, after all that bull trending, after trending from 2013, being finally in a bull market for 2013 all the way up to 2021, are we finally in a much needed crash? Right? Do we really need a crash? No, but we do need a pullback, and the pullback is here. We hit 50% retracement, 348, 348. 11, 349.14 on the Fibonacci's. So when do we fall into a bear market? Because that's the other thing a lot of people are asking or saying. We're in a bear market. No, we're not in a bear market. We are still in a bull market with a 50% retracement. This is a healthy pullback, especially coming off of COVID lows to now, right? That's a healthy pullback. Still not as much of a pullback that needs to be done since we've been running from 2013 to current. All right, let's take a peek, see where that pullback would be if we again just do a simple Fibonacci. Okay, not do anything crazy, just pulling back from the time we got over the double top. All right, there it is. Whoops. Get to the double top, and let's pull that Fibonacci up. Oh, it didn't do it that time. Let's do it. Let's try it again. Hey, Fibonacci, all the way up to here. So where are we going to go? There you go. To get a healthy pullback from 2013, which is the beginning of our bull trend that we had, okay, the possibility of getting to 315.22 is going to be very likely. Now, back, let's see, roughly around when we were dancing on the 408s, 410s just recently, I made a prediction even then. I put it on our socials stating that once we reject this fourth peak, this max line of resistance, this up here, okay. Once we reject right here, we're going to come down and see 340. All right, actually 336, 336.29. So this is why we're roughly going to be seeing that around about February, mid-February, March is where we're going to see that price range. Once we hit that price range, we're going to get another peak back up again. Now, I don't anticipate us actually getting all the way back up to 400 again. I think this is where we're going to start jumping out of this trend and jump into another channel. Okay. If you also notice right here, let me change this up real quick. Something to be cautious about. This is a pattern that a lot of people are failing to recognize right now. If you have not gotten a pattern book, you should look into getting a pattern book because patterns, whether it be hourly, daily, weekly, monthly, it doesn't matter. Patterns are patterns and patterns are there. This is a megaphone on a down excuse me, on a downtrend. This is as bearish as it's going to get. So again, the answer to the question is, are we in a crash? Is no, we're not in a crash. We are in a pullback at this point in a bull market. Now, when do we finally get out of this bull market, okay, and finally hit a bear market? That's what I want to know. I bet you want to know that same question, right? When do we finally get out of this bull market and land in a bear market? That's a lot of people's question. So just by simply doing this silly thing right there, there you go. That's when you find out you're in a bear market. Hitting around 315.22, if it breaks this ascending line of support from March 9th of 2009, if it breaks this line of support, which is all the way up here around 315.22 based on the timeline this has already given us. If we break that, then we are now in a bear market. We broke the bull trend, okay, and got us in a bear market. That's when we're in a bear market. But nothing here so far, just doing simple Fibonacci's, basic 101, and analyzing the chart, okay? Any new person can do this if they're willing to study and learn about patterns and how to chart it out with on basic levels. Just looking at it on a basic level, you can now see that we are not in a crash. We are not even in a bear market. We're just in a downward trend on a bull market. We have not got out of a bull market yet. We are dealing with a downward trend, a massive downward trend. As you can tell, a years long downward trend. This is not, we have not fell into an actual bear market yet. Understand there's a difference between a bearish pattern, right? This is a bearish pattern versus bull market. All right. Let's see if we can do something real quick while we got you on. Then we're gonna cut it out here. Show you something all the way here. We'll keep it on the weekly. There we go. Now you look at on a bigger scale. That's the market. Okay, from 1933. This is the SPY market, the S&P 500. This ain't the Nasdaq or Dow. This the SPY, but it still gives you a relative idea of what we're looking at. That's the market. How does this look like a bear market? All right, on a grand scheme of things, how is that a bear market? This is where you start waking up and realizing, crap, we're not in a bear market. We're still in a bull market. We're just on a pullback, a much needed pullback, a pullback that we've been needing for quite a long time. Now, how we get into a bear market? There you go. Again, as you see on a bigger grand scheme of things, it doesn't tap till about 315.22. Okay. I bet the next question you're asking right now is where's the bottom? Where's the bottom of the market? Well, the bottom of the market, right? It's obviously, let's get right there. Obviously, $77. That's the bottom. Now, let's talk a little more realistically. Are we going to get there? No, absolutely not. We're not going to get back to $77. We're not even going to get to $149. We're not even going to get to there. All right. Think realistically. People saying we're going to get down to 100 or 99 or even zero are fanatics and pair of bears that just thinks this is the whole thing. The world's going to end. All right. This market has dealt with the Great Depression. Okay. And this thing still didn't fail. This thing has went through pandemics, from Great Depressions to recessions, and the market keeps thriving. This is historical data right in front of your face. Historical data that shows you no matter what kind of crisis is going on, the one thing that continues to survive and flourishes is the market. So that being said, all right, the chances of us getting down to 77 or 149.38 is next to none. Not saying it's impossible, just saying it's next to none. Okay, it's something you're not going to really see anytime soon. Now, here is something that might be kind of scary for a lot of people. What about 217.73? That is a more likely scenario than 149.38 or $77. But I still don't see that happening. What I believe we're going to hit the bottom of, right, is a roughly around 276.08. That's where I see the bottom of this whole mess ending up. Then we're going to do a little bit of chopping around. We're going to come up, possibly even double top 479.98, not break out, double top it, and then come back in again. Very similar, okay, to right here. This right here is the same exact thing. All right, we had this nice extended push up, come back down, right, and then it comes up, double tops. If you notice, look at the years. The 2000 crash. We push up from 2002 all the way up to 2008. Now we have the 2008 crash. Then 2008 pushes all the way up. We don't get back up to here till 2013. All right, so to give you a historical data, to give you an idea how far this can go. There it is. 2.5 years from 2000, 2008. It only lasted about a year and a quarter for 2008. So this one, we are already a year in. So chances are we probably got another year, roughly about a year. Almost 2 years. Around November is when we finally hit 315.22, and that's going to send us up back up again. All right. So that's what I'm saying right now. Again, just on a simple basic level. If you want to know more and you want to see how I'm able to get all this figured out, you can go back and check out my socials. You'll see before we got to 350, I called out 350. When we got to 348.11, I said we will not see this price again until we get to 410. We got to 410. And then now once we got around 408, 410, I've already called it out while we're still up here in the 400s. Well, right now, 389.16 is current price as of right now. But I was calling around about 403, 408. We're going to see 340s. All right. And we're going to see 340s roughly about March. That's what I'm seeing based on the charts. I'm not using bias. I'm not using my own opinions. I'm using historical facts that shows me how these patterns play out to give me a more accurate idea of where this thing could go. Nothing's a guarantee, but it does give me an idea where it could go, which will allow me to make my positions a little bit less riskier and a lot more profitable. Okay, so that's what we do here, and I hope you enjoyed what you saw. I'm going to cut this short here instead of doing my typical close to about 20 minutes. I'm going to go cut it here. If you like what you saw, please like, share, do whatever it is. I promise you, you know about YouTube and how to operate this thing way better than I do. I'm lucky I even figured out how to do this. All right. The one thing I'm good at is being an analyst. I can chart this doggone thing left and right. I can gut it and I can present it to you with actual facts that get you what you need, the information to be able to make better decisions on when you take your trades. All right. So that's it for me. My name is Nick, and this is Sneakers Bullpen. I hope you enjoyed it. Come back and check us. Check out our Discords, our Twitters, our all the social medias are here. Have fun. Have a great time. Safe trading.